Welcome to Queensland Property Intelligence. There is a question many investors are asking right now. With interest rate above 4%, is Queensland property at risk in 2026? Over the past 2 years, the RBA has lifted the cash rate aggressively. In theory, property market should weaken, but Queensland property hasn't collapsed. So what's really happening? Let's break it down with a structure, not speculation. The Reserve Bank of Australia has raised the cash rate to 3.85%. That's a significant shift from the near-zero environment we had not long ago. Higher rates reduce the borrowing capacity, they increase holding cost, and they slow buyer sentiment. But they don't automatically cause price crashes. That depends on supply and demand fundamentals. Looking at public data from PropTrack and CoreLogic, Brisbane recorded double-digit growth in 2023, continued upwards in 2024. And while growth has moderated, price has not reversed dramatically. That tells us something important. The market has slowed, but it hasn't structurally broken. According to Australia Bureau of Statistics, Queensland continues to receive strong interstate migration. That matters, because housing demand is driven by people, not headlines. Meanwhile, vacancy rates across Brisbane have remained historically tight. Low vacancy means rental demand remains firm. That creates a floor under the market. Now, let's have a look at the structure. Brisbane is a mature capital market. Lower volatility, more stability. Logan offers higher yield, but is more sensitive to settlement shifts. Ipswich has supply considerations, partially in new development corridors. Gold Coast carries higher price points and tends to move more with investor confidence. There isn't one Queensland market. There are multiple sub-markets with different risk profiles. Where is the real risk? The risk today is not collapse. The risk is mispositioning. Investors who over-leverage or rely purely on capital growth assumptions are more exposed in a high-rate environment. But investors who manage cash flow and buy in supply-constrained areas are positioned differently. What happened next? If rates begin easing in late 2026, we could see renewed buyer momentum. If rates remain elevated, the market may consolidate, not cash. The key question isn't, will price fall? It should be, are you positioned to withstand volatility? And are you buying in a market with long-term structured demand? If you are looking at Brisbane, Logan, Ipswich, or the Gold Coast, and want a structured breakdown of risk, yield, and demand fundamentals, comment us, and I will share our PDF file we use to access investment positioning in the environment. This is Queensland Property Intelligence. We'll continue to analyze the market with clarity.